Hello, my name is Joey Bierman, and I decided to do my company analysis over Berkshire Hathaway. And I'm going to first start off by giving you a little information over their company overview. Berkshire Hathaway is a diversified holdings group. The company, through its affiliates, concentrates on conglomerate insurance and reinsurance. Um, it deals with property and casualty insurance and life and health and accidental protection products. There are other business affiliates through the company. It mainly functions here in the United States, and it is headquartered in Omaha, Nebraska, and is led by Chairman and CEO Warren Buffett. Next, I would like to talk about Berkshire's financial analysis. So for that, we're going to talk about first the liquidity ratios, and the two short-term solvency ratios I'd like to talk about are the current and quick ratios. What you'd like to look for in a firm is to have a current ratio above 1, because having a current ratio less than that baseline of 1 indicates that net working capital is at a negative, which is definitely not a good thing. For Berkshire, having a current ratio of 3.13 shows that they're a good ability at paying the short-term bills. Now, comparing the Berkshire's current ratio to one of the leading competitors in the industry of Progressive, their current ratio is of 3.17, which also is more than the baseline of 1, along with above the industry average of a 1.56. Next, the financial leverage ratios, or long-term solvency ratios, they signify a firm's long-term ability to meet its obligations. The two financial leverage ratios used here are the total debt ratio and total debt to equity ratio. Berkshire's total debt ratio is at a 0.50, with their debt to equity ratio is at a 0.22. Both ratios are at a better clip compared to the industry competitor Progressive, which shows that the Berkshire is in good financial health at paying its long-term obligations with assets rather than using those to pay those bills through borrowing. For Berkshire, the total asset turnover is at a 0.37, while Progressive is even higher at a 0.73, which means that Berkshire, for every 0.37 cents of every dollar in assets, produces 0.37 cents in sales, which is not much higher than the industry of a 0.23. Next, we're going to talk about profitability ratios. Berkshire has a profit margin of 18.56%, and Progressive has a profit margin of 5.8%, relative to the industry average of 8.56%. As for the return on assets, Berkshire Hathaway is at 6.79%, and Progressive is at 4.32%, both above the industry average of 1.93%, respectively. For the return on equity, Berkshire Hathaway is at 14.24%, compared to the industry average of a 7.21%. Companies really pay attention to their profit margin. It's a pretty big deal in affecting their bottom dollar. And what this is saying, that Berkshire is generating a little bit more than 18 cents in profit for every dollar in sales, compared to the industry average of 8.5 cents per dollar. They're making more than average profit. On return on assets, Berkshire is making just under 7 cents for every dollar in assets, versus Progressive making just over 4 cents in every dollar in assets. The fact that return on equity exceeds return on assets reflects on Berkshire's financial leverage. Next, we're going to talk about the price to earnings is one market value ratio. As of June 13th of 2018, the Berkshire's PE ratio was 12.1 versus Progressive's 22.76, compared to the industry of a 16.2. Berkshire has a relatively low price earnings ratio compared to the industry competitor Progressive. Next, I would like to talk about Berkshire Hathaway's SWOT, the strengths, weaknesses, opportunities, and threats. Berkshire has established a culture that Warren Buffett has proven to work, which is one of the strengths here. Next, we're going to talk about the strong capital positions and ratings that the company has shown. Next, diversified competitive positions held by their subsidiary companies. Some of the weaknesses that I see, Warren Buffett makes all the financial decisions, and if he steps away or if he passes away unexpectedly, it could be a disaster for Berkshire. Next, the overdependence on the McLane Company, on Walmart. Some cost efficiencies and operating expenses associated with the rise in insurance losses could be a weakness too, because Berkshire is one of those insurance conglomerate companies. Some opportunities is the revival of the U.S. railroad industry, which could boost revenue for BNSF. Increasing the Big Four to the Big Seven investments could likely increase earnings. Berkshire, to get more business outside of the life insurance sector, could be another opportunity that I see fit. And some threats could be the insurance fraud, various regulation changes in the insurance industry, increasing the natural catastrophes and affecting the insurance companies. Just over this last year, there's been those 3 hurricanes and those couple wildfires, which definitely affect the insurance company. And then just talking about some of the, just like the recommendations that I would kind of suggest for the company. Berkshire is able to have a competitive advantage due to their strong brand image and recognition of the world's most renowned investor of Warren Buffett. But it's vital for the company as a whole not to be over-dependent on the image of Warren Buffett. Coming up with a succession plan, having more checks and balances within the organization and ease the company as a whole and ease the shareholders, just their ease of mind. But as of this year, Berkshire Hathaway has named Abel and Jane as vice chairman of Buffett for the successions plan. And then some other important things for Berkshire is to promote brand awareness. I think this is important for people of Berkshire, for their company as more than just a company that Warren Buffett owns, because he's just a guy that people recognize, and they may not know what Berkshire does other than, Warren Buffett works for them. Next, Berkshire will need to continue pursuing different types of companies and businesses that will further diversify the company and create more revenue for their shareholders. Next, I think lowering that dependence on McLane, as they consist of almost 25% of Berkshire's total revenue. A change in their distribution and their distribution strategy could really compromise Berkshire's bottom line. And finally, I'd like to talk about the effective and efficiency revenue claims to avoid fraud, as efficiency in those claims could definitely affect those fraud. If there's any questions, I'd like to answer those. But thank you guys for listening.